Welcome to this free training module from My Care Consultant. My name is Tony Miles and I'm Technical Director of independent care navigator firm My Care Consultant, and together with my colleague Jacqueline Berry, in this module we're going to I'm going to spend the next 30 minutes looking at the treatment of income and saving investments in local authority financial assessments for social care. Exactly how much a local authority or council will pay towards someone's care depends on what care is needed, whether it's deemed by them to be eligible, and how much that person can afford to pay. The first step is for the local authority to do an assessment to check how much help someone needs and whether those needs are deemed eligible as assessed against national criteria. And this is called a needs assessment. If a person is deemed to have eligible needs, the council will then do a financial assessment or means test to work out what you'll have to pay towards the cost of your care. This works out if the council will pay the full cost of your care, or the council pays some of the cost and you pay the rest, or that you pay for all of your care. Now, following the government plans for social care announced on the 7th of September 2021, we now know that the thresholds to be used in determining capital taken into account will change in England with effect from October 2023. But it looks like there will be no change in respect of how income and capital are assessed. Certainly, there will be no change for the next few years. So, what we're going to look at today is how eligible income and savings investments are actually assessed to arrive at this. We're not going to touch on related topics such as deprivation of assets, well, not much anyway, just simply how capital and income are treated and some of the issues we often have to address when helping clients prepare for a local authority financial assessment. We're also not going to look at the actual needs assessment of financial assessment process today, but you can find details of both on key information sheets within our online technical resource Carebox, both of which you can see on the screen right now. And at the end of today's session, we'll explain how you can access this support via a free, no obligation, 1-month trial of Carebox. So what we're going to look at today is one aspect of the financial assessment, namely how eligible income and savings and investments are actually assessed to determine how much someone will need to contribute towards their care. Specifically, the learning objectives for this session are, firstly, to understand the basis of local authority financial assessments for care. Secondly, to review the treatment of capital assets and local authority assessments for care. And then finally, to review the treatment of income. So, when it comes to looking at local authority financial assessments, it's important to understand that social care is a devolved matter, with differing social care systems operating across England, Northern Ireland, Scotland, and Wales. When it comes to the treatment of capital and income in England, the definitive source of guidance for local authorities and councils can be found in the 600-page plus statutory guidance to the Care Act 2014, in particular, Annex B, which covers the treatment of capital, and Annex C, which covers in Northern Ireland, in Scotland, and in Wales. Each, in effect, operates a version of what used to apply in England, namely the Changing for Residential Accommodation Guide, often referred to as the CRAG rules. Although there is much in common across all, and the old CRAG rules that used to be used in England have in the main been uplifted into the Care Act statutory guidance. So when it comes to looking at local authority financial assessments, it's important to understand that social care is a devolved matter and that there are differing systems operating in England, Northern Ireland, Scotland, and Wales, as I've just said. And of course, the recent changes announced by the government only apply to England. Now, the first thing a local authority will assess is a person's capital. The above rather busy slide summarizes the capital thresholds applicable in each of the home nations in 2021, 2022. In England, Northern Ireland, and Scotland, this involves an upper capital threshold over which all will have to pay their own social care fees until such time as their assets fall below this level. and a lower capital threshold below which the value of their assets are ignored for the purposes of a financial assessment to pay. And as previously mentioned, these threshold levels are due to change in England in October 23, but are as on the screen for the next year or so. In between these two levels, capital is translated into what is known as tariff income, to be added to income subsequently assessed, again to determine ability to pay. Interestingly, in Wales, there is only one threshold, currently 50,000 for residential care and 24,000 for care at home. There are no upper or lower threshold. So anybody who has assets above 50,000 will have to pay. Anybody below 50,000 when it comes to residential care won't. Obviously, again, income comes into play. There are some other discrepancies that I really don't have time to go into, but the broad principle that currently applies is that those who have the assets or income to pay for their social care will be expected to do just that. And unfortunately, in our experience, the reality of this often comes as something of a bit of a shock to those in need of care or their loved ones. Now, when it comes to capital thresholds, I now want to turn to how someone's capital assets are treated to determine whether they are over this threshold and whether or how much they are expected to pay for the care. And I want to look at what is defined as capital for the purposes of the local authority financial assessment, how ownership is determined and treated, how the value of a capital asset is actually calculated. What about capital assets that are held abroad? Do they count? And what about capital assets not readily realizable? Not easy to say. So let's go to the first of these. What is defined as capital? Well, capital can mean many things, and the statutory guidance gives local authorities the flexibility to, and I quote, consider the individual asset on its merits. That said, the guidance does highlight certain types of capital, buildings, land, stocks and shares, premium bonds, national savings certificates, and Ulster savings certificates. Any savings held in bank accounts, building side accounts, SAYE schemes, unit trust, and cash, etc., etc. However, the key point to bear in mind is that a person's personal possessions or any life assurance policies are excluded, and I'll come back to that in a bit. Capital also includes property, and that's a whole subject in its own right. But I just want to say a few things about property at this stage. Suffice to say, firstly, someone's main or only home will not be included as an asset in the means test when care and support is being provided in the home. It may also be disregarded even when the person is going into permanent residential care if someone else living in the property qualifies for what is known as a mandatory disregard. The statutory guidance and CRAG rules contain a list of such people, but key amongst them are, as is perhaps no surprise, spouses and civil partners. The second thing I want to say about property is a local authority can use its discretion to apply a property disregard in some other circumstances. However, the local authority will need to balance this discretion with ensuring a person's assets are not maintained at the public expense. An often quoted example is where the property is the sole residence of the person's previous carer who gave up their own home in order to care for them. This disregard would come to an end and the value of the property would be taken into account if the carer were to die or move out. Now, local authorities don't have to make an exception like this, but they should give full consideration to a request to do so. And thirdly, if an individual's capital assets other than their home amount to less than the upper capital threshold, currently 23,250, but due to increase to 100,000 in October 2023, the local authority is obliged by statute to disregard the value of the individual's property for 12 weeks from when they permanently move into residential care accommodation or until the property sells, if that's sooner. And this is basically to give owners time to sell their homes. Having said all this, for some, it's not always clear whether such property should be included in a financial assessment or not in the first place, due to the statutory exclusion of personal possessions and the spectrum of ownership status of assets like this, such as long-term leases to licenses. Also, some possessions are not easily classified. For example, mobile homes, caravans, or houseboats. HMRC does provide some guidance on how these homes are typically dealt with from a stamp duty perspective, which can often be used to inform local authorities' positions when they are carrying out a financial assessment. Apart from property in some circumstances, there are a range of other capital disregards, and Carebox again contains a key information sheet that details all excluded capital, a copy of which you can see on the screen. Now, whilst we don't have time, unfortunately, to go into all of these, we will touch on a couple of common ones in a bit. But if, again, as I say, if you haven't taken advantage of a free trial of Carebox, so you can look at these documents, please do take advantage of it, and we'll talk about that at the end of today's session. In terms of ownership, whose capital are we talking about? A capital asset is normally defined as belonging to the person in whose name it's held, the legal owner. However, in some cases, this may be disputed and or beneficial ownership argued. Now, beneficial ownership is where someone enjoys the benefits of ownership, even though the title of the asset is held by someone else, or where they directly or indirectly have the power to vote or influence a transaction regarding a particular asset. In most cases, the person will be both the legal and beneficial owner. In simple terms, the local authority cannot include capital or income that belongs to the person's partner in their financial assessment. So things like joint savings will usually be halved. A local authority will also need to work out what the value of a capital asset is in order to take it into account in the financial assessment. And usually valuations will be the current market value or surrender value of the capital asset, whichever is higher, minus 10% of the value if there will be any actual expenses involved in selling or realizing the asset, and any outstanding debt secured on the asset, an obvious example being a mortgage in the case of property. Where capital is held abroad and all of it can be transferred to the UK, its value in the other country should be obtained and taken into account, less any appropriate deductions as just mentioned. And where the capital cannot be wholly transferred to the UK due to the rules of that country, for example, there may be currency restrictions in play, the local authority should require evidence confirming this fact. Examples of acceptable evidence could include documentation from a bank, a government official, or a solicitor in either country, or this country, or the country where the capital is held. As well as capital assets held abroad, one issue that we come across that often causes confusion is how capital that is not readily realizable is treated. If you look at the statutory guidance, it states the following, and I quote, "Capital which is not immediately realizable due to notice periods, for example, National Savings Bank investment accounts or premium bonds, should be taken into account in the normal way at its face value. This will be the value at the time of the financial assessment. It may need to be confirmed and adjusted when the capital is realized. If the person chooses not to realize the capital, the value at the time of assessment should be used and it should be reassessed at intervals in the normal way." Now, as previously mentioned, some capital is disregarded, including any personal possessions, such as valuables, paintings, antiques, unless they were purchased with the intention of reducing capital in order to avoid care and support charges, and also things like life insurance policies. And I'd like to touch on the latter now. The statutory guidance, Appendix B, Section 54 states, and I quote again, Where an investment bond includes one or more element of life insurance policies that contain cashing in rights by way of options for total or partial surrender, then the value of those rights must be disregarded as a capital asset in the financial assessment. Identical wordings to this are used in the CRAG rules that apply to the other home nations. So investment bonds would be disregarded, but capital redemption bonds, which, as you know, differ from normal investment bonds in that they are not contracts of life assurance, would not be disregarded and their surrender value included. Having said all this, one matter to be very careful about is that an investment bond is not specifically taken out because of care cost concerns. Anyone who places funds into investment bonds, where a motive for the investment is to avoid care fee charges, runs the risk of triggering the deprivation rules and having the value of those bonds treated as a capital asset for the purpose of means testing. The purchase of an investment bond in this regard is specifically mentioned in paragraph 9G of Annex E of the statutory guidance as an example of deliberate deprivation. And again, I quote, "A person can deprive themselves of capital in many ways, but common approaches may be," and then they give examples, including where assets have been used to purchase an investment bond with life insurance. What this means in practice is that advisors need to be very aware of the deliberate deprivation rules, specifically in respect of motivation in taking out an investment bond, as well as when it was taken out, was there a realistic expectation at that time of needing to pay for care at some future point? So timing is a key issue here. In a nutshell, if the need for care is anticipated or likely in the near future and or a significant reason for taking out an investment bond is the possible disregard of the capital involved in respect of a future local authority assessment around care, then your client may well be captured by the deliberate deprivation rules. If the need for care is not anticipated beyond some, future statistical likelihood due to age alone, then there are often significant reasons, there are other significant reasons for investing capital in an investment bond. Be aware of the importance of documenting suitability accordingly. And I personally would avoid stating the capital disregard position itself, especially in respect of investment bonds and care. The only other point I'd make at this stage is that actual payments by periodic installments from an investment bond, with or without insurance, will be treated as income. So that would include any 5% tax deferred withdrawals. Now, full details of the treatment of investment bonds in local authority financial assessment can be found in a summary sheet within Carebox, again, that you can see on the right-hand side of this screen. Okay. What I'm now going to do is give you a rest from me and hand you over to Jacqueline Berry to talk about the treatment of income. And I'm just going to stop sharing my screen and hopefully Jacqueline will be able to take it over. Jacqueline, over to you.
Thanks very much, Tony. I'll just be a moment or two, hopefully, and we'll get moving into my section. Tony, can I just ask you to confirm you're looking at the treatment of income slide?
I am, but I can also see your notes on the right-hand side.
No worries. How about now?
That's better. That's fine.
Thank you. That's fabulous. Right, let's move into my section. So yes, thank you very much, Tony, and hello again, everybody. So now let's move on to the treatment of income to look at how the local authority looks at that. Now, income only comes into play when an individual in need of care has capital assets below the upper threshold. And as Tony previously mentioned, in England, Northern Ireland and Scotland, capital between the upper threshold and lower threshold is translated into tariff income at a rate of £1 for every £250 of savings. In Wales, they only operate one threshold, so that doesn't come into play. And as Tony already mentioned, tariff income is another aspect that will be changing when the new government plan comes into play in October 2023. Okay, so the first thing to stress is that only the income of the cared for person can be taken into account in the financial assessment of what they can afford to pay for care and support. So where a person receives income as one of a couple, the starting presumption is that the cared for person has an equal share of the income. A local authority should also consider the implications for the cared for person's partner, something that would come into play, for example, where all the income is being generated by one person. In general, though, income will always be taken into account unless it is disregarded under the regulations. Income that is disregarded will either be partially disregarded or fully disregarded. Now, I don't have enough time today to go over the fine detail in terms of what's partially or fully disregarded, but what I want to highlight is some specific aspects of the treatment of income that we frequently come across and where some of the confusion sits, namely those on screen. So let's start with employed and self-employed earnings. Now, one aspect of income that might sound counterintuitive is that of earned income. In all cases, irrespective of setting, employed and self-employed earnings are fully disregarded. Essentially, this is linked to the principle of well-being, which is a key component of the Care Act, and the belief that taking into account earned income in a financial assessment would undermine this. So in practice, someone could be immobile in a care home, but running an online business generating earned income that would be ignored in any initial or subsequent financial assessment. Clearly, the accumulation of such income as capital would then, in all likelihood, be subject to the capital thresholds, and giving it away might well be caught in the deliberate deprivation rules. So even here, the matter is by no means simple or straightforward. Moving on to notional income. In some circumstances, a person may be treated as having income that they don't actually have, and this is known as notional income. This might include, for example, income that would be available on application but has not been applied for, income that is due but has not been received, or income that the person has deliberately deprived themselves of for the purpose of reducing the amount they're liable to pay for their care. In all cases, the local authority must satisfy itself that the income would or should have been available to the person. I think it might be useful here if I highlight two specific matters that arise from this. And the first is the impact of pension freedoms post-April 2015. And the second is how notional income impacts on benefits. So in respect of pension freedoms, if a person is only drawing a minimum income or choosing not to draw income at all, for example, from a drawdown contract, then a local authority can apply notional income. This must be the maximum income that could be drawn under an annuity product. If applying maximum notional income, any actual income should be disregarded to avoid double counting, unless the individual is drawing down an income that is higher than the maximum available under an annuity product, in which case the actual income that is being drawn down should be taken into account. At My Care Consultant, this is increasingly an aspect of financial assessments that we see local authorities getting wrong. For example, we had a client who was in drawdown but taking zero income and was told by her local authority that only the income being taken at the time she was going into a care home would be taken into consideration during her financial assessment. Clearly, this is at odds with the statutory guidance. In respect of benefits, local authorities take most of the benefits people receive into account, subject to some that are disregarded, such as the mobility component of disability living allowance or personal independence payments. Where someone is not claiming nor in receipt of eligible benefits, this is where notional income kicks in again, and local authorities will apply notional income in such cases. This is why understanding entitlement to and claiming benefits is important when an individual is subject to a local authority financial assessment to determine what they'll pay towards care, and why our third, apologies, that's not actually out. This isn't. We're obviously giving this one away free, so we're not doing the third module, but that can be found in Carebox for those that want to sign up, and I'll give more details about that later. So it's worth pointing out a somewhat grey area, however, in that individuals should be able to retain enough of their benefits to pay for things to meet the needs are not being met or deemed eligible by the local authority. So at this point, I just mentioned Carebox there. We have lots of client-facing resources, and one I wanted to point out now in relation to the topic we've just been discussing is a key information sheet entitled The Treatment of Pensions in Local Authority Financial Assessments for Care. This can be accessed in Carebox, which Tony mentioned earlier, and I will provide information at the end of the session as to how you can access Carebox if you're not already a member. Okay, so moving on to personal expense allowance. Now, local authorities also need to ensure that individuals in a care home retain a personal expense allowance. And this money is for the person to spend as they wish, and any pressure from a local authority or provider to do otherwise is not permitted. That said, the amount in question is arguably derisory. So for 2021-22, the figures are £24.90 a week in England, £27.19 a week in Northern Ireland, and £29.30 a week in Scotland, reaching the dizzy heights of £33 a week in Wales, where it's referred to as the minimum income amount, rather than the personal expense allowance. In a non-care home setting, local authorities must also ensure that a person's income is not reduced below a specific level after charges have been deducted. The amounts are set out in the Care and Support, Charging and Assessments of Resources regulations. However, this is only a minimum, and local authorities have discretion to set a higher level if they wish. The purpose of the minimum income guarantee is to promote independence and social inclusion and ensure that they have sufficient funds to meet basic needs such as purchasing food, utility costs or insurance. This must be after any housing costs such as rent and council tax net of any benefits provided to support these costs, and after any disability related expenditure. Now, when it comes to capital thresholds, personal expense allowances, and minimum income guarantees, these and other important benefits and care data can be sourced via a free information sheet available to all. At My Care Consultant, we have a few areas within Carebox that are not locked down to subscribers or those on a free trial. So if you go to LinkedIn and type in the link details on the screen, you can download it from there. Alternatively, contact us at My Care Consultant and we'll send you a link to a free copy. And again, details of how to contact us will be at the end of today's recording. So finally, Tony and I have both referenced Carebox today and the material that sits within it. And Tony and I both mentioned that I would explain how to take advantage of a free trial. So it's really simple, no payment details needed. Just use the link on screen right now and click on the Start a Free Trial button, which you can see on screen. We just need your name and email address, and Bob's your uncle. So total access to all resources will be available through the free trial, with the exception of our consumer guides that are only available to paying subscribers. But you can see a preview if you'd like to have a look at those to see what they're about. Okay, so this is the link to buying a membership if you decide you'd like to sign up either now or following your free 1 month trial. Hopefully you'll agree the £14.99 cost of a monthly membership is reasonable and works out as about the same as one posh coffee a week. So we hope we've kept prices very modest. Okay, so here are the learning outcomes that I hope you and Tony feel that we've delivered today. Sorry, I hope you feel Tony and I have delivered today. Thank you so much for listening, and I'll now close the session, and we very much look forward to seeing many of you in Carebox very soon.